All right, today we've got a story that has everything. Nobel Prize winners, Wall Street legends, and a financial bet so ridiculously huge it nearly tanked the entire global economy. This is the incredible story of long-term capital management. And really, the entire saga just boils down to this one single question. What happens when the smartest people in the room, armed with these Nobel-winning formulas, are just so convinced they're right that they can't even imagine being wrong, until reality comes along and proves them catastrophically, epically wrong? To really get a feel for the risk here, you have to appreciate the just mind-boggling scale of this thing. LTCM, the fund, had about $5 billion of its own capital. But through borrowing and complex derivatives, they were controlling positions worth a staggering $1.25 trillion. So, who were the brilliant minds behind this massive bet? And how in the world did they convince everyone they'd found a foolproof way to print money? Well, it all started with a team that, on paper, looked completely unbeatable. I mean, the sheer brain power they assembled was just staggering. You had John Meriwether, a total superstar trader from Salomon Brothers, and he teamed up with not one, but two recent Nobel Prize winners, Myron Scholes and Robert Merton. This wasn't just another hedge fund. This was the financial equivalent of an all-star team. And their whole game was built around this concept called arbitrage. You know, it's kind of like finding the same book for $10 in one store and $10.05 in another. You buy the cheap one, sell the expensive one, and you pocket that nickel, betting that eventually the prices will become the same. LTCM was doing that, but on a global scale, with super complex financial instruments.
But here's the thing. How do you turn those tiny little nickels into billions of dollars? See, arbitrage by itself won't make you rich, because the profits on each trade were just microscopic. They needed an accelerant. They needed a rocket.
So a typical trade for them would look something like this. They'd spot a corporate bond that was yielding just a tiny fraction of a percent more than a super safe U.S. Treasury bond. Their model would tell them that tiny gap, that little 0.05% spread, was an error, a market imperfection that was bound to close. And they would bet billions that it would. This was their three-step money machine, their magic formula. Step 1, find a microscopic pricing error. Step 2, borrow absolutely massive amounts of money from banks who were, by the way, lining up to lend to these guys. And Step 3, use that borrowed money, that leverage, to turn a tiny, tiny profit into an enormous one. And for a few glorious years, man, it worked like a charm. Between 94 and 97, they were delivering returns over 40% a year. I mean, they were absolutely crushing the regular stock market. The genius model was working perfectly. But then, in 1998, something happened that their elegant mathematical formulas had basically said was impossible. See, their models assumed that the market was rational, that it was predictable. They never ever accounted for a true black swan event, something driven by pure, raw human panic. It started with a financial crisis over in Asia, but the real trigger, the shot heard around the world, was Russia. On August 17, 1998, Russia defaulted on its debt, and that sent this shockwave of pure panic through global markets. Investors everywhere started dumping anything that seemed even a little bit risky and just piling into the safest thing they could find, U.S. Treasury bonds. And just like that, every single assumption their models were built on was proven wrong, all at the same time. Instead of those little price gaps closing, they blew out wider than ever. The market wasn't rational, it was terrified. And worst of all, liquidity, the ability to actually sell your stuff, it just vanished. They were completely and utterly trapped. What came next was one of the fastest, most brutal collapses in the history of finance. The very same leverage that had magnified their gains into the stratosphere was now magnifying their losses at a terrifying speed. The speed of this thing was just breathtaking. On one single day, August 21st, the fund lost $553 million. That was 15% of their entire capital, gone, in a matter of hours. The rocket ship was officially in a nosedive. The destruction of their capital was swift, and it was total. Look at this. They started 1998 with almost $5 billion in equity. By the middle of September, less than 9 months later, almost all of it was gone.
And here's the part that is truly terrifying. Even with almost all of their own money wiped out, they still controlled over $100 billion in assets. Their leverage ratio skyrocketed to an unbelievable 167 to 1. Think about that. For every single dollar they had left, they owed someone else $167. It's insane. Okay, so this was no longer just about one hedge fund failing. The entire global financial system was now staring right into the abyss. LTCM had become what we call a systemic risk.
And from the Federal Reserve's point of view, the goal here wasn't to save the partners at the fund. No. The rescue was about saving everyone else from them. The big fear was that a forced, chaotic fire sale of LTCM's assets would trigger a chain reaction, a global financial meltdown. So why all the panic? Well, because LTCM was connected to everybody. They were like a spider at the center of a giant web. They had borrowed from and traded with nearly every major investment bank on the planet. If LTCM went bankrupt, nobody was sure who would be the next domino to fall. So the New York Fed calls this emergency meeting. They basically strong-arm 14 of Wall Street's biggest banks into a locked room and forced them to bail out their own competitor. The banks coughed up $3.6 billion to take control of the fund, just so they could unwind its massive positions slowly and prevent a full-blown market crash.
So the immediate crisis was stopped. But the story of LTCM left behind some deep scars and some very, very uncomfortable questions that, honestly, we are still grappling with decades later.
And this raises a huge question for our time, right? Today, we have infinitely more powerful computers and AI running our markets. But if the absolute pinnacle of human financial genius failed because their models couldn't account for pure human panic, are we just setting ourselves up for a faster, bigger, more complex failure next time?
And this whole thing leaves us with one final, provocative question. By saving the system from LTCM's failure, did the Federal Reserve create a dangerous precedent? Did it basically teach Wall Street that if you get big enough, if you get interconnected enough, you can take insane risks, knowing you'll probably get a bailout if you fail? It's a question that would come back to haunt everyone just 10 years later during the financial crisis of 2008.